different private and public financial instruments in the market. Our agenda is introduction, content, reference, conclusion. Introduction. The financial market is made up of both private and public financial products. They offer a range of chances for investors to make an investment and increase their wealth. Public financial instruments are often supplied by government agencies, whilst private financial instruments are typically provided by private held businesses. The purpose of this article is to examine the various private and public financial instruments and how they are used in the market. Private financial instruments. First, stocks represents ownership shares in public trade companies. Investors who purchase stock become partial owners and can profit from price appreciation or dividends issued by the company. Second, bonds. Bonds are debt instruments issued by company or government to raise capital. Investors who purchase bonds are essentially lending money to the issuer for a fixed period, and in return they receive a regular interest payments and the principal amount upon maturity. Third, mutual funds. Mutual funds pool money from multiple investors to invest in the diversified portfolio of stocks, bonds, or other sources. Investors in the mutual funds own shares proportional to their investment and benefit from professional management and diversification. Hedge funds. Hedge funds are investment funds that pool capital from according investors to employ the various strategies to generate high returns. They often utilize a complex investment techniques such as short selling and derivation and have fewer regulation compared to mutual funds. 5. Private equity. Private equity involves investing in privately held by companies or acquiring controlling stakes in a public companies. A private equity firm raises funds from institutional and wealthy individual investors to invest in the businesses with the aim of improving their performance and generating returns. 6. Venture capital. Venture capital is a form of private equity that focus on early stage high growth companies. Venture capitals provide funding to startups in exchange for equity and often play an active role in the company's management and growth. 7. Derivatives. Derivatives are financial contracts whose value is derived from an underlying assets. They can be used for hedging against risk or scalping on the price movements. Examples include options, futures, and swaps. Public financial instruments. First, treasury bills. Treasury bills are short-term debt security issued by governments to raise funds. They have a maturity of 1 year or less and are considered low-risk investments. Investors purchase the treasury bills at a discount and receive the face value upon maturity. Second, government bonds. Government bonds are long-term debt security issued by governments. They typically have a maturity ranging from 5 to 13 years and pay periodic interest to investors. Government bonds are considered relatively safe investments. Third, municipal bonds. Municipal bonds, also known as munis, are debit instruments issued by the state or local governments, municipals, or government-related entities. These bonds are used to finance public infrastructure projects such as schools, roads, hospitals, or utilities. Municipal bonds can have a varying maturity and may be issued with either fixed or variable investor rates. Second, treasury notes. Treasury notes are medium-term debit instrument issued by the government with the maturity typically ranging from 2 to 10 years. They pay periodically interest to bondholders, usually every 6 months until the maturity when the principal is repaid. 5. Treasury bonds. Treasury bonds, also known as T-bonds, are long-term debit instrument issued by the government with the maturity typically ranging from 10 to 13 years. These bonds pay periodic interest to bondholders until maturity, at which point the principal amount is repaid. 6. Saving bonds. Saving bonds are non-marketable debit security issued by the U.S. Department of the Treasury. These bonds are designed to provide a safe and accessible saving option for individuals, as saving bonds can be purchased at the face value and accrue interest over time. They have special maturity periods ranging from several months to up to 13 years, depending on the type of saving bonds. 7. Social Security. While not traditional financial instrument, Social Security is an important Social Security is an important part of the public financial system. Social Security is a government program that provides income and benefits to eligible individuals, primarily retired, disabled individuals, and serving spouse and children. Funding for Social Security comes from payroll taxes paid by workers and employees. Summary. In conclusion, the private and public financial instruments offer investors various avenues to participate in the market and achieve their financial goals. Private instruments such as stocks, bonds, mutual funds, and others for potential returns. Public instruments including treasury bills, government bonds, and multiple bonds are interest payments. Understanding these instruments is crucial for marketing information, investors' decision, and maximizing potential returns while managing risk. Thank you.